Is Comfort Delgro finally back on track for sustainable growth? Or are its overseas expansion risks outweighing all this talk of higher margins and market share? Hey investors, welcome back to the Investing Iguana. I'm Iggy, and today we'll dig deep into Comfort Delgro's latest numbers, just adapted from my in-depth Substack deep dive. If you want better investment decisions for your CPF or SRS, this is the breakdown you need. For those new here, I'm a Singapore-based financial analyst with years covering transport and infrastructure names like Comfort Delgro, SBS, and SMRT, plus regular sector reviews on how your money can work harder, whether it's in CPF, SRS, or your SGX picks. Here's what we're covering today, chapter by chapter. The new Comfort Delgro. What's changed for 2025? Slide-by-slide financials with updated data, key figures, and what they mean for local investors, where overseas revenue is now coming from, and why Singapore returns matter more than ever. My personal verdict is Comfort Delgro a buy, hold, or sell for your portfolio this year. Stick around, because every statistic is aimed at making your decisions clearer. Let's start at the top. Comfort Delgro is no longer just Singapore's transport backbone. For the first half of 2025, overseas revenue jumped above 54% of group sales. That's a real transformation, and it didn't happen by accident. Revenue is up by 14.4% to $2.42 billion, and PATMI, meaning profit after tax and minority interests, rose 11.2% to $106 million. The kicker? While profits are up, PATMI margins barely budged, dipping to 4.4% from 4.5%. That suggests the company is pushing hard for growth, but costs are rising about as fast as revenue. The story? This is mostly acquisition fueled. Addison Lee in the UK, A2B and CMAC elsewhere, all brought into the family within the past 12 months. And let's not forget the big new Manchester bus contract, which started in January. Ask yourself, if most growth comes from buying new businesses, are those gains really sustainable next year? Time to look at the numbers. Here's a simple summary of Comfort Delgro's financial progress. Revenue stands at $2.42 billion this half versus $2.12 billion last half, up 14.4%. PATMI is $106 million compared to $95.3 million, up 11.2%. PATMI margin is at 4.4%, down just slightly from 4.5%. Interim dividend raised from 3.52 cents to 3.91 cents per share, up 11.1%. What does this tell us? Growth is solid, but margin pressure is real. Management stuck to their promise, offering 80% payout. So yield is still attractive at 5.5% at a 143 share price. If you're counting on CPF and SRS yield, that's above what you'll get in OA rates. The real shocker? More money now comes from outside Singapore than within. Great for diversification, but also means more exposure to pound, euro, and global regulatory risks. Net gearing closed at 16.6%, way below management's self-imposed 30% ceiling. That means plenty of dry powder left before leverage becomes a problem. What's driving future earnings? First up, winning back London contracts on better terms. Management says that's helping improve UK profit margins. The Liverpool franchise bid could mean more growth if the team gets it past local politics and union agreements. Then there's the tech play. AI is now used in London and Singapore for smarter bus and rail scheduling. Plus, Comfort Delgro is helping lead Singapore's government push towards driverless fleets. Management says that could pay off big in 3 to 5 years as labor markets tighten or EV uptake accelerates. But there's a thorn. Ride-hailing apps are eating share, and China's consumer pullback is hurting their taxi rental income. Management admits market growth in these areas is likely to be flat or shrink further for the time being. Let's break down the critical numbers. Revenue came in at $2,422.7 million, up from $2,117.5, a growth of $305.2 million. Operating costs are up to $2,057.8 million from $1,803.1 last year. Operating profit is up to $172.5 from $140.5 million. PATMI, as mentioned earlier, is $106 million, up from $95.3, a change of $10.7 million. The story here? Revenue up by 305 million, but costs climbed nearly as quickly. The extra 7.8 million in purchase price amortization is purely from buying those new businesses, and net interest expenses are up as borrowing rises. Put simply, this is a higher risk, higher spend phase. Is every new dollar of growth worth it? The first half 2025 balance sheet remains solid. Total assets rose 3.4% to $5.92 billion, reflecting major fleet purchases for the new Manchester contract and London's EV bus rollout. Liabilities increased, linked mainly to debt raised for these strategic fleet expansions. Liquid resources, cash, and short-term deposits finished at $873.1 million, demonstrating healthy day-to-day capacity for working capital plus a rainy day or small acquisition. Equity didn't move much, which means shareholders weren't diluted, but Comfort Delgro is taking on more risk by borrowing instead of issuing shares. For CPF and SRS investors, that's usually the safer bet, as long as returns beat interest costs. Check out these numbers for cash flow. Operating cash flow was $333.3 million, up from $321.2. Net capex nearly doubled to $497.0 million from $196.8. Dividends paid out, $119.4 versus $96.3 last year. Net borrowings ticked up to $365.4 from $294.4. A massive $497 million net spend on buses and tech. It's a temporary spike, says management, but it means they need to keep generating solid operating cash. Dividend policy stayed intact, payout above 80%, signaling confidence, but also tying their hands if earnings slip. Net debt jumped to $603.7 million. Net gearing now at 16.6%, up by nearly 10 points in a year, but still below 30%. There's plenty more they could borrow if more acquisitions or EV fleet upgrades come calling, but careful watch is needed as interest rates, even globally, aren't falling fast yet. Here's the CapEx breakdown. Buses, mainly Manchester and London EVs, ate up $308.5 million this half, up from $109.2. Taxis, mostly diesel to EV conversions, took up $69.2 million, compared to $57.3. Land and buildings, important for depot upgrades, was $95.7, up from $21.5. Others, including smaller initiatives, was $25.3. Overall gross capex finished at $522.3 million, more than double the previous period's $213.0. A huge bet on electrification and overseas scaling. Will that translate into sustainable profit or short-term balance sheet squeeze? Numbers show Singapore is no longer the profit engine. UK and Australia now drive the story. Singapore revenue slipped to $1,107.5 million, while UK and Europe shot up to $866.1 from $548.7. Australia was up to $405.3 from $308.8. Only China slid down to $43.3 from $49.9. The big leap in UK-EU more than made up for Singapore's dip, but with this diversification comes more regulatory uncertainty. China remains weak, as flagged, while Australia improves as talent shortages are addressed and contract execution picks up. Management expects steady contract revenue in the UK-EU for the rest of the year, and margin resilience is their key focus. The Liverpool opportunity is still open, but not guaranteed. In Singapore, the headwinds continue. Competition keeps fares down, and taxi demand remains weak. The interim dividend is set at 3.91 cents per share, an 11% increase, keeping the payout at 80%. At Swan 43, that's a 5.5% yield, easily beating CPF rates right now. Here's my verdict: hold. Comfort Delgro is in play for real growth, but the market already sees much of the UK and acquisition upside. Swan 43 looks fairly valued. Consensus targets are higher, around $1.69, but risk factors, like China drag and SG's shrinking taxi pool, won't disappear overnight. As a CPF or SRS holding, Comfort Delgro remains a solid high-yield anchor. But if you're buying for growth or capital gains, best to wait for price dips closer to zone 40 payouts or for clear profit improvement in overseas bus operations. For income-first Singaporeans, the dividend is rock steady, payout discipline is tight, and exposure to UK-EU boosts diversification. Still, add to your position only on dips or positive surprises. So what have we learned? Comfort Delgro is no longer just Singapore's bus and taxi king. It's diversifying, buying up growth offshore, and betting big on electric and autonomous transit for the future. Income is stable, but for now, growth upside is balanced by new risks. Take these lessons into your SGX investing journey. Focus on what fits your portfolio goals, CPF, yield needs, and risk tolerance. Smash that like, share, and subscribe if this helped clarify your next move. For the full breakdown, playbook, and more, join our premium investor crew on Substack. Get all my deep dives and market alerts first. And if you want to keep learning, check out my transport sector trends breakdown. Link on screen now. Remember, investments are personal. Stay informed, stay skeptical, and stay invested with purpose.